Hey guys, it's Jansen here and welcome to my channel. Now, this video is going to be a little different from the usual. I've decided that I want to start helping my viewers just to smash it in all areas of life. So I'm going to be using my background in banking, finance and investments to help you guys start to understand a bit more about the investing world. So this video is going to be covering the different types of investments that you can make if you're based in the UK or anywhere else for that matter. And the beauty about this video is that you're going to be able to actually make an investment if you choose to do so with whatever capital you've got. You know, the investments that I'm going to be walking through in this video, you can do with very little of your savings. So, you know, I'd normally recommend having at least £100 in order to be able to see a decent bit of growth in your funds. But, you know, by all means, if you don't have that much, you can still make a start. So in this video, we're going to be walking through the most common type of investments that you can make that are beginner friendly. Everything that I'm going to be talking about in this video, you're going to be able to do like after having watched this video and being given an introductory speech about it. So I really hope that you enjoy this content. It's something that I've been wanting to do for a while. As much as I love Amazon FBA, there are other topics that I do feel that I'm quite experienced in. So in the future, I'm going to be talking more about these topics as well to help ensure that you guys smash every single part of your lives. Okay, so the way that I'm going to be presenting the different types of investment that you can make is going to be in this format, so a pyramid. And the pyramid is structured like the investments at the bottom of it are low risk, but therefore lower reward. And then as we move up the pyramid to the riskier types of investments, that's where you're going to start to get higher reward in exchange for the higher risk that you're taking. So we're going to be mainly targeting the bottom half of the pyramid, because as you get towards the top of the pyramid, you need to be a bit more sophisticated, and it's not something that I would recommend for complete beginners. I want this video to be something that could be understood by absolutely anybody, including people that have got zero experience in investing. So yeah, as you move up the pyramid, the more sophisticated you're going to need to be, really, but everything in this video is going to be catered towards beginners. And the beauty is, as I just mentioned, that everything in this video you should be able to at least consider if you have a low starting budget. I would recommend having at least £100, but if you've got a bit less than that, then do feel free to still consider some of these options. Now, in terms of where you decide to look when it comes to investing your money, that is really going to come down to three separate things. So first of all, it's going to come down to your attitude to risk. If you are very, very risk averse and you're like, I've got these savings and I don't want there to be any risk of losing any money, then you're going to really need to stick to the very bottom of the pyramid. Whereas if you're a bit more open to, you know, possibly losing some of your money, but also the possibility of making quite a bit more money, then you can obviously start working your way up the pyramid. So that needs to factor into your decisions of where you invest. The second thing that is a big factor in deciding whether to invest or where to invest is how quickly or how much you need that money. So if you are saving at the moment to buy a house, I would not recommend making investments such as in the stock market or anything else where the value can fluctuate quite quickly. And the reason for that is plainly because the stock market is volatile and it can go up and it can also go down. It always depends on what's going on in the wider world. So my advice is, if you need like the money that you're saving within the next 1 to 2 years, I would stick to savings in the bottom tier of the pyramid, versus if you're happy to make an investment or have a pot of investment and you're like, you know what, I probably don't need that money for at least 3 to 5 years or more, then that's when you can start to consider the rings higher up in the pyramid. And then finally, the final thing that you absolutely must consider when deciding whether you want to invest is whether you have outstanding debts. So if you've got a massive credit card bill and it's got a high amount of interest, my advice is pay that off first before you start thinking about investing in other companies or wherever, because that the risk is quite high, and in all likelihood, the interest that you're going to be paying on that credit card or whatever debt that you owe is going to be higher than the initial returns that you're going to make on the investments that we're talking about today. The only exception to that is a mortgage. A mortgage is usually a loan that you have to purchase a house. The difference there is that mortgages are typically quite low, charging in interest, so sub 3%, and they're paid off over a long period of time. So if you've got a mortgage, that's fine, provided you have got disposable income to make investments. You can definitely consider this. But if you do have credit card bills, or you owe, friends or family like money that's got interest on it, I would focus on paying those off first. But this video is still well worth watching to make sure that you understand the different types of investment that you can make, as well as the different amounts of return that you can expect to achieve when making an investment. So the different types of investment that I want to cover in today's video are going to be bank savings, premium bonds, and government bonds, which are at the low end of the return spectrum, but they also are low risk. Some of those should be familiar to you, but we'll cover them quickly anyway. Then we're going to be moving up slightly in terms of the amount of risk and the amount of return, and we're going to be looking at passive funds. We're going to be looking at blue chip or mature company shares, and then we're going to be looking at investment grade bonds. And then we're going to be covering active funds. So there's a slight difference between active and passive funds. We're going to be looking at small, high growth shares, and then high yield bonds. So if you don't know what any of those are, that's good, because I'm going to be teaching you that today. In addition to that, as you climb up the pyramid, there's also other investments that you can consider. So cryptocurrency like Bitcoin, commodities, and then moving up again into derivatives. Now, those two top tiers, I'm not going to be covering in today's video. I might cover in a future video. My view is that those are quite advanced products to be considering, mainly because they're also very volatile. So I'm going to save that for a future video. So that's a summary of this video. Let's now kick off. So the first type of investment that you can make within the low risk, low reward category is simply in cash, i.e. keeping your money in a bank account. Now, unfortunately, for as long as I can remember, interest rates in the UK have been incredibly low, and they're not expected to increase anytime soon. So that's a big disadvantage to just investing in cash. The fact that the return is so low, it's sub 0.5%. There is a way that you can increase that return ever so slightly by using an ISA. And an ISA stands for individual savings account. And the way that it increases your return is because the return, i.e. the interest payments, are tax free. So everyone in the UK gets an ISA limit or allowance every single year. And provided that you don't go over that limit, any returns, so any interest payments that you receive, are going to be tax free. Now, other advantages of having a bank account and just saving via cash is that the cash is very easy to get out. So as I mentioned, if you want to buy a car, buy a house, there's no penalties, and you can just get your cash out immediately. And of course, the risk of losing any of your money is incredibly low. Banks are covered by various laws, regulations up to a certain amount. So you're protected in the event that the bank goes under, which is very, very unlikely to happen in the UK. So those are kind of the main advantages and disadvantages of investing in cash, i.e. a bank account. And of course, you guys know this like very well, hopefully. There's providers such as Santander, Lloyds, and TSB. Now, a second option that you can consider in terms of investing is what's called a premium bond. So if you haven't heard of one of these before, a premium bond costs £1 per bond, and it's backed by the government. And essentially, you buy a certain amount of bonds up to a maximum of 50,000. So you've got, you can invest up to 50,000, and every single month there's like a prize draw, a lottery, so to speak. And there are prizes all the way up to £1 million. So the good thing about this is it's a bit like investing in the lottery, so buying a lottery ticket, but you can get your money back. It's very easy to get your money back. There's a slight delay of around 7 to 10 days, so you can't get it out as quickly as you could with a bank account. But, there's always the chance of winning £1 million, right? Well, the disadvantage of that is that the prize rate is very low. It's 1%. And that doesn't even mean you're guaranteed to win anything. That's just, you've got a 1% chance of winning a prize, which could be as low as £1. It could be as high as £1 million. The actual odds of winning £1 million, I checked, and it's like 1 in 64 million, or something like that. So the odds are very, very low, and they get worse each month as more premium bonds are issued. But that is something that, for those of you that maybe think you're a lucky person or you like to gamble, so to speak, even though it isn't gambling, and that's something that you could consider. And another advantage of premium bonds is that the winnings are tax-free. So anything that you get, that you win, you don't have to pay any tax on it. So if you are interested in that, as I say, it's very low risk, but also very low reward. You just simply go onto the National Savings and Investment website and you can buy them very easily. And if you decide to sell them in the future, you'll get your initial investment back. Happy days. The final investment in the low risk, low reward category is a government bond. So this, quite simply, is you lending money to the government, which a lot of people don't think happens, but it does. It's just done like not on the front page of the newspaper. It's done pretty much every week, in fact. So the way that it works is you buy a certain amount of bonds, very similar to premium bonds, except the minimum investment is going to be like lots of £100. So each bond costs £100. You do have to do it via a certain platform, via a broker. So it's not actually that accessible, but it's something that you could definitely consider. Now, the upside of government bonds is that it's backed by the government. So again, it's very unlikely that you will lose your money, and you get monthly income. So you're getting monthly interest from these. However, the downside is that, as you know, interest rates in the UK are extremely low. I actually looked at the yield, so the return of some of these government bonds at the moment, and some of them are even negative, i.e. you're having to pay to do it. Now, that's a whole nother topic, why somebody would do that. People do it, or rather institutions do it. But the point is that I'm trying to make here is that returns here are very, very low. And to me, it doesn't really make sense if you're somebody that wants to be in the low risk, low reward category. It doesn't make sense to be looking at this. I'd rather look at the ISA option or even premium bonds. Okay, so we're now moving up to the next level of the pyramid. We're in the medium risk, medium reward category. This is the area that I like to invest in myself. It's a bit more exciting than just investing in boring old cash. But remember that the risk is slightly higher. So with these options here, there is a chance that the value of your investment could go down, but also go up. So just keep that in mind as we're running through these options here. So the first asset class that we're going to look at are corporate bonds at the investment grade level. So I'm going to break down what that means now. So a corporate bond, it works in a similar fashion to, say, a government bond. It's effectively money lent by a group of investors to a company. So plenty of companies out there issue bonds, i.e. they say to investors, please can you lend us money and we will repay you over the course of, say, 6 or 7 years. The way that bonds work is that the company repays interest every 6 months for however long the bond is issued for, so say 6 years. And then at the end of the 6 years, the actual total amount of the bond is repaid. So as I mentioned, tons of companies out there issue bonds. You've got Tesco, Microsoft, Apple, Shell, tons of them. Now, all of these companies here, the ones that I've just mentioned, they are known as investment grade companies. And that basically means that they are very established companies. The risk of them going bankrupt or just losing a ton of market share is low. And because of that, because they are investment grade, the interest that they pay on their bonds is low. And that is why the asset class here is called investment grade. It's a high class of investment, which basically means that the interest payments are slightly lower. So that's how the bonds work. The upside of investing in these corporate bonds is that you get a fixed amount of interest income every 6 months. So you can kind of guarantee that you're going to receive that, provided that the company doesn't go bust, which shouldn't happen given that they are classed as investment grade. Now, the downside of that is much like the government bond example, it is quite tricky for normal investors, retail investors as we're known, to invest in that. You do get some like companies issuing retail bonds, so like Tesco have, which means that it's very accessible. But typically, if you want to invest in a corporate bond, you're going to have to go through a broker of some sort. Now, again, another downside of these corporate bonds is that, as I mentioned, it being investment grade, the returns can be a bit lower than other types of bond. So returns can be below 5%, which is still pretty good, I think, around 5%. But it's also quite difficult to get your money back. So if you lend money to a company in the form of a bond, then as I mentioned, that bond is going to be outstanding for say 6 or 7 years. So it is possible to sell your bond to another investor, but there's a risk that you have to do that at a loss. So again, this type of investment is not for those of you that are looking to invest somewhere and you only want to do it for say 6 months or a year. So just take that into account. Now, the second asset class that we're going to look at are shares. So for those of you that aren't familiar with how shares work, if a company is public, it basically means that anybody can buy a share in that company and own a portion of it. So there are many, many companies out there that are public. To name a few, you've got Tesco, BP, Apple, Vodafone. Like there are tons of companies out there that are public, which allows you to buy a share in them, and technically you own a portion of them. Now, obviously, with billion-dollar companies like Tesco, Vodafone, etc., if you just buy one share, you're going to own a very, very small percentage of them, but you're still an owner nonetheless. Now, when I'm talking about this category here, I'm describing the shares as blue chip or mature shares. So blue chip, again, is very kind of similar to investment grade. If you say it's a blue chip company, it just means it's an established company. It's got a defensible market position. It's not going anywhere. So, big companies like Apple, Microsoft, Tesco, they're all blue chip companies. They're huge and they're safe bets. Now, with examples like Tesco, Sainsbury's, Vodafone, these are all blue chip but mature companies, okay? And typically their share prices are very stable. So you can kind of rest assured that if you do invest in them, if you buy a share, that the price of a share is not going to be fluctuating huge amounts. There's not going to be huge swings on a daily basis. Now, because of the fact that these companies are mature and typically they are lower growth, it means that you're not going to get any return from the share price increasing if you do invest in them, but you will likely get a return from a dividend. And a dividend, quite simply, is where companies like Tesco just pay out a proportion of their profits to investors. So Tesco could say at the end of a financial year, we've made X amount of profit, and because of that, we're going to be paying a 50p dividend per share. So that means if you are an investor in a company like Tesco, you'll get, for each share that you own in them, a 50p return. And that is a fantastic way at basically getting a return on your money. If you buy, say, 100 shares in Tesco at £5 a piece and they pay, 50p dividend for 100 shares, then you've got a return on that, in addition to a possible return in the share price increasing on the shares that you own in Tesco. So a great benefit of investing in these blue chip shares is that typically you will get a dividend. So you're getting yearly income. However, with dividends, it's not guaranteed. If Tesco just said, we've had a bad year, we're not going to be paying a dividend this year, then there's nothing you can do. But typically with these massive companies, that's not something they do unless they've had a terrible year or for some other like strange circumstance. You can also ensure that your returns, so your dividends, are tax-free if held in an ISA. And this is something I'll talk about in a future video. I mentioned it in the previous category. ISAs stand for individual savings accounts, and whatever investments you make, whether it just be in cash or in a company, whatever return that you get on that investment, you don't pay any tax. So I'll talk about that in more detail in a future video. And then as well with investing in blue chip shares, the world is your oyster. If you want to invest in an American company, in an Asian company, in a European company, then you can. So, you're getting different kind of exposure to different geographies, different industries, etc. Now, the downside of investing in things like this in this category is that, first of all, as I've mentioned, the dividend it can be suspended or can be reduced. You also have dealing charges. So if you're starting with a low investment of say £20 and you only want to buy one share, well, quite a big proportion of that £20 is going to be taken up with a dealing charge. Now, there are different brokers that charge like quite low rates to allow you to buy a share, but typically, the fee is between £5 and £10. So just take that into account if this is something that you want to consider. And then one additional downside of just investing into a single stock, so a single company, is that you're not very diversified. So let's just say, for example, you put all of your investment into Tesco. Well, if Tesco has a bad year or just something goes wrong for them and their share price goes down, then your entire portfolio, i.e. your one share investment, it's going to go down in value. So if you are considering investing in a company to get dividends or just to get an increase in share price, I would always recommend investing in more than one. And that's a big disadvantage, but that brings me on to the final asset class, which is the solution to that. Final asset class in this category, which is a passive fund. So a passive fund, if you're a beginner, might be something that you haven't heard of before, and it might sound quite complicated, but fear not, it's actually fairly straightforward. So what is a fund? Well, it is effectively a collection of shares that a fund manager or somebody else has chosen. So if I, for example, wanted to invest in all of the biggest companies in the UK, rather than me buying shares in Tesco, BP, Vodafone, Sainsbury's, etc., I can just buy one share in a fund that has exposure to those companies instead. So it's actually quite simple, right? Now, the fantastic thing about funds is that there are tons of them. There's a fund for the biggest companies in the UK, the biggest companies in the US, tech companies, companies in Asia, etc., etc. So we are really spoilt for choice. Now, the type of fund that fits into medium risk, medium reward category is something known as a passive fund. And a passive fund is something that basically contains shares that just reflects a certain market. So you might have got a fund that literally reflects the biggest companies in the UK. And the reason that it's called a passive fund is because you don't need a fund manager to actively choose which investments should be in that fund, because it's quite easy to see which are the biggest companies in the UK. You just look on the stock exchange and you look at which ones are the biggest, right? So because of the fact that these funds are passive, there's not really an active fund manager that's saying, actually, I don't like this company. Actually, I like this company. They're all just like reflecting certain indexes or markets. Because of that, the fees are very, very low. And that is a brilliant advantage. You can invest in certain funds, say the biggest companies in the UK, for like less than 0.5%, even lower than that. So that's something that I've been looking into a lot recently, these passive funds, because they require limited research. You don't need to worry about researching every single company individually. You can just research the fund and look at what companies it's invested in at a high level. Because of the fact that these funds invest in so many companies, upwards of 30 companies, you're getting automatic diversification. So we spoke about previously how if you invested in Tesco on its own and it had a bad year, then you risk possibly losing some of your investment if the share price goes down. However, the upside with a fund is that that's unlikely to happen like across the board. If Tesco has a bad year, that might be for a certain reason, but other investments within that fund might have had a good year, so it kind of nets off. Now, obviously, you can't say that for sure, but generally, these funds like perform in line with the general market. So if the market is doing well, like generally UK companies are doing well, then you can kind of have a bit of assurances that a fund that reflects the UK market is also going to do well. So that's another advantage. And then, as I've just mentioned, there's so much choice with these funds, lots of different industries and markets that you can choose from. And that, again, is something that I'm going to delve into in a future video. I'm going to be talking about the types of funds that I've been looking at investing in, just to kind of give you guys an idea of what's available out there. Now, a disadvantage of funds is just like with share prices, the price could go down and the value of your investment could go down. However, if you're investing over the longer term, which is something that I would highly recommend for just investing in the stock market, then, the chances of losing your investment are going to be reduced. Then also, in addition to that, another downside is because these passive funds just reflect a market in general, you can't pick and choose what companies you do and don't want to invest in. So, if you find a fund that is invested in all of the biggest companies in the UK, and you're like, well, I do like the biggest companies in the UK, but I don't like Tesco, then, you haven't really got an option there. You either invest in it or you don't. But, because of the fact that these funds are so big, they contain so many companies, the risk of Tesco doing badly and pulling down the whole fund itself is quite low. So if you are interested in investing in one of these passive funds or looking at them, the two biggest providers are known as Vanguard and iShares. So if you just type that into Google, type in Vanguard funds, you'll get a list of all of them, and you can have a look at the different types of funds that they offer and even consider investing in them. But remember, guys, for everything on this category, I would really recommend taking it into account that you need to be investing for, I'd say, at least 18 months with any of these, or you don't need your money in the next 18 months because, with anything that's market facing, the value can go down slightly. But all of these returns here, they offer, I'd say on average, around 10% or lower. There are absolutely some funds, some passive funds that have had fantastic returns that are well worth considering. But on average, everything here, I'd say, is going to give you a return of 10% or so. Okay, so we're now going to go up to the next level of the pyramid, and this is going to be the last one in this video. This is the higher risk, higher reward category. You can get anything from 10% plus with all of these options. Some of these you can even get 100% returns. But remember, obviously, the risk is higher. So the first asset class that we're looking at is the high yield bond. Now, this works in the exact same fashion to the corporate investment grade bond that I spoke about, but it's known as high yield. The reason being that the companies that have these are higher risk. So they're not classed as investment grade, they're not as established, or they're in more volatile markets. So examples of some high yield bond issuers are Netflix, Pizza Express, Virgin Media. There are tons out there. These are the ones that I thought you guys would be familiar with. Pizza Express, as some of you may know, is a pizza restaurant in the UK. It hasn't been doing that well lately. So because of that, people are a little unsure of whether it can actually afford to make interest payments on its bonds. And because of that, the interest rates on its bonds are higher. So the pros of investing in these, the advantages is, well, you've got a fixed guaranteed level of interest provided that the company can afford to make those payments, and it's higher than the investment grade category. So high yield bond returns range from 5% to 15% each year, but you've obviously got to take into account that there is a higher level of risk versus the investment grade option. And again, the downside with the just like the previous investment grade option is that it's quite hard for retail investors to get access to unless you go via a broker, and you can't sell out immediately easily without running the risk of losing some of your capital. So again, if you need the money, within the next year, this isn't something that I would consider. Then if we move on, we have got shares in small companies or high growth companies. And the reason that these are a little more volatile than before is because these companies are typically newer or they're fast growing. So because of that, their share price is very volatile. Now, because of the fact that they're fast growing, you can make an absolute fortune on returns. So for example, I think Amazon, you guys know all about Amazon and how like fast they're growing. You know, if you'd invested in them this time last year, you would have made upwards of 70%, I believe, on in terms of your investment. But the downside is it's risky. Okay, there's no guaranteed income. These companies typically don't pay dividends because any cash they do get, any profits they make, they're reinvesting in order to grow. And because of the fact that they're so fast growing, their earnings can be all over the place. The share prices are very volatile. So you need to be very careful with this asset class. You need to be confident on any research that you do, or just confident in the company if you're going to invest. It's not something that I would recommend for people that are only looking for short-term gains. So if you want to invest today and sell out in a month, I mean, there's obviously you can certainly make money doing that, but there's also an increased amount of risk that you need to bear in terms of losing your money. So the disadvantages of these is very similar to share prices, investing in shares that we spoke about before. So you've got dealing charges, share price can go down very quickly. If you look at Tesla's share price, you'll see that although it's grown rapidly, it also drops very quickly too. If based on what the CEO Elon Musk is feeling like that day, what he decides to tweet. And then as well, you've got single company exposure. So if you're just invested in Tesla, you're not diversified. You're exposed to one company, to one industry, and basically one country as well. So it's not really recommended. But some people do decide to invest in multiple companies. It's all down to your risk appetite. And then finally, I'm aware that this video has gone on for quite a while now, but I did kind of want to cover the main asset classes that you can invest in. The final one is, again, a fund, but this one is active. So this one works in a very similar, or if not basically the same as the passive fund, but instead of the fund tracking a certain index or a market or whatever, this type of fund has got an active fund manager. So just say, for example, someone like me, somebody that's saying, okay, these are the companies I want in my fund. I don't want these companies, etc. So they're actively choosing it. Now, the advantage of investing in these funds is that they require limited research for you to do, because you can rely, hopefully, on the fund manager to have done their own research. They're diversified, so you're not just investing in one single company, you're investing in a fund that's invested in lots of different companies. And the kind of like active fund universe is ginormous, way bigger than passive funds. There are funds for every single type of company, industry, geography, you name it. Like, you can just search in different fund databases and there are tons. So you really are sport for choice. And because of the fact that these funds are active, so they're actively managed, somebody is choosing what goes in these funds, they can outperform the market. So if the UK top 100 companies in the UK are growing on average, say 5%, then a passive fund that tracks that can only really grow 5%, whereas an active fund can easily outperform that. And that also gives a big upside advantage in a downturn. So in a recession, you're going to be a bit better protected in the event of a recession, because companies that aren't performing will be taken out of the fund by the fund manager. Whereas with a passive fund, there's no fund manager adding and removing companies. It's all just done based on the index or market that's being tracked. Now, in terms of the downside of an active fund, well, just like with everything else that we've spoken about in the higher risk categories, the prices of the fund could go down and your initial investment could lose some of its value. But the biggest kind of downside with these active funds is that the fees can be quite high. So typically you'll be paying, because you're actually paying for somebody to manage the fund. Typically you're going to be paying like around 1.5% of your investment per year. So you really do need, the fund to actually return for you in order to pay for itself. But there are funds out there that get humongous returns. Like, some of them get upwards of 100% a year. But obviously you need to take into account that the value of the fund could also go down. So providers out there, examples of active funds managers are Fidelity and Fundsmith. And again, this is something that I'm going to be covering in more detail in a future video. So that was a summary of the first 3 tiers of the risk reward pyramid. Obviously, there are many other types of investments that you can make that fit within these 3 categories, but I felt that the ones that I'd run through in this video are the ones that are most accessible to complete beginners and to people that don't have much like starting capital. But the thing that I want to kind of hit home with this video is before you make any investment decision, you should always consider your own attitude to risk. So how open you are to the possibility of losing some of your startup capital, whether you have any outstanding debts. So if you do have credit card debts, please make sure that you pay those off first before investing in the markets or anything like that. And then also how quickly you need the money. So it's all well and good saying, yeah, I've got a high risk attitude. I'm happy to take on some risk, but I need the money in 6 months. That's not going to work when you're investing in the stock market. Of course, you might make a return, but it's always best with stock markets, anything that's market facing, to be investing over the longer term. So I really hope that you've enjoyed this video, guys. As I've mentioned throughout, I'm going to be teaching you a bit more about different types of investments that you can make and just everything that I know about the investing world. As I say, my background is in banking and finance, so it's not just Amazon FBA that I know about. If you have enjoyed this style of video, please do let me know. And if you do have any requests about things that you'd like me to cover, again, please let me know down in the comment box below. Otherwise, guys, I'll see you next time.